All right, today we are talking about private equity and the way that we think about our business. So even though we may feel like we're a small company and we're growing right now, having the end in mind is always extremely important and valuable as we're building the foundation to our companies. And that is why we have the most amazing woman here with us today, Leah Berend. Did I say that right?
Berend.
Berend. Yeah. Should have practiced more.
Emphasis.
Yeah. Anyway, thank you. So she is with Oxbow Industries, and they're all about private equity. So I'm going to let you introduce yourself a little bit more and talk about what you do. And then also what I'd like you to talk about is your approach that's different from the typical, stereotypical private equity world. So I'm going to let you take it away.
Yes, and I don't know, you guys can see me well. I am not a finance bro. I am not wearing a Patagonia vest. So I am a different breed than what's usually in the private equity world. And that's a good thing. As Midori was saying, and again, thank you so much for inviting me to speak today. I'm so excited to share this because it's really something I'm very passionate about, and I hope that you see that and feel that as I talk today. Why private equity? So let me give you a kind of a 50,000 foot view. You see the public markets, the stock exchange, you may pay attention, you may not. A lot of people's 401k is in, public company stocks, ETFs, index funds, all that, which is about 4,500 companies. Really, that's it. The stock market is basically composed of less than 6,000 companies on a day-to-day basis. So a lot of your 401ks and investment funds are based in really big, Apple, Microsoft, the names that we all are familiar with. You don't have that many companies in the public market. In contrast to that, there's over 1 million private companies in the United States today. And so as investors seeking an edge, seeking a way to get above market returns, you start to look in other places, which is how private equity has been born over the years. The first private equity transactions happened in 1940s with JP Morgan kind of buying into different stakes of companies. But then you have the corporate raiders of the 80s who would come in and kind of do a hostile takeover and then divide out and sell and flip and stuff. And so you have a lot of misconceptions built up over the years about what private equity is. It's also not venture capital. And so really, when you think about it, there's a lot of different avenues of investing, and private equity is one of those kind of alternatives to the stock market and the public markets. So who are we? We're Oxbow Industries. We've been around for nearly 20 years, investing in lower middle market companies, which means that we're not investing in Fortune 500 companies. We're investing in the companies that are running the American economy. And so what we're doing is investing in mature companies. So not on the venture side, right? Because venture is kind of, early stage Series A, Series B rounds. What we're doing is taking, an investment stake in mature 10-year-old, 5-year-old companies, $10 million in revenue, and we are helping to grow them. A lot of the time, what we do is take a founder-owned company, and we love partnering with that founder who's looking to either retire and they don't have a clear succession plan, or they want growth equity for their company and they're not able to just go into a bank and say, hey, I need $50 million, right? And so we bring in a lot of resources, a lot of expertise in that financial realm, and we're able to generally help the management team buy out the owner or get the owner some liquidity from their business. And so that is one of the many exit strategies that there are today. And so a lot of the time, Oxbow Industries has partnered with founders and done what we call like a leveraged buyout, where we're getting debt and then we put in equity, and then we're giving that liquidity to the owner and taking on either a full ownership stake or a minority equity stake in the company. And for instance, one of our companies went public in 2021. We've had other companies that are still private, but have grown substantially just with our investment in them. And we've had some pretty successful exits. Now there's others that, you know, may not have been as successful down the road, but that's kind of the risk that we take on as investors. And so that's kind of hopefully a good explanation of what private equity does. We try to partner with the management. We're very deferential in our approach. We're not, Oxbow Industries is not a fund. So we don't raise outside capital. You're going to see a lot of differences in the private equity world. And one of my goals is to help break down those kind of myths about private equity, that it's all just one way. It's all just a bunch of guys in a room who are raising a bunch of money from a bunch of other guys, and they're gonna invest in these companies and then take them over and flip them in 3 years and completely ruin the culture, completely, you know, kind of decimate all the intangible benefits of that company. What Oxbow does, we're investing our own capital. So there's a lot more skin in the game. We're putting our own money to work in these companies. And so we have a much more vested interest in the performance. And you know, because it's our own money, we're not charging kind of huge management fees on the back end to our investors, because that's really how private equity firms make money in the interim between, you know, buying the company and selling it, as these management fees that they charge on the investments from their fund investors. So, like I said, lots of different approaches built into private equity, and I'd love to answer your questions about that. If you have any now, but I can move into kind of the different exit strategies that there are for companies next. Jill?
Hi, good morning. Thanks for being here. Question is, I come from the tech world, so obviously I'm more familiar with VC versus private equity. So I'm guessing you're going to get to that, so you don't have to answer that question right now. But I think it would be good to kind of understand, I'm familiar, I've done angel investing and things of that nature. So kind of good to understand what private equity offers versus VC type of thing.
Yes.
So it doesn't have to be right now.
So just as a quick explanation, venture capital is again for those earlier stage companies that are high growth. Private equity plays in that area, but it's more for established companies that have a longer operating history, that have a, you know, kind of a steady progression of growth over time, versus, you know, your spray and pray mentality of investing a little bit in like 20 companies as a VC firm and, you know, hoping that one makes a moonshot, right? And so that's really the difference, is that venture capital, and I use the term underwrite because there's venture debt and there's venture capital. They're underwriting who's on the board of that company, who's the leadership of that company, who, you know, what are their prior startup type investments, or what is their prior business performance. Well, private equity looks at that, and it's important. We're also looking at, has this company had net profitability over time? What is their, you know, what is their EBITDA over time? And so we're looking at, you know, financial metrics, as well as the board, as well as the, you know, the management of the company, et cetera, and the market, you know, as a whole. So that's really the difference, is that there's a lot less risk, you know, as far as what we're trying to mitigate out, versus venture capital, which is a lot riskier, but also higher reward. And I see another question here. So Silicon Valley Bank was not private equity. They were venture debt. And so what they did was very prolifically in Northern California and then all over the country. They were doing venture debt investments. And so one thing about finance, it doesn't really make sense when you're taking on debt. When lenders want you to take on debt is mostly when you don't need to take on debt. So what venture, and I was actually just at the first venture debt conference in New York City that they've ever had a couple weeks ago. And they were talking about how, you know, this whole Silicon Valley Bank collapse happened. And everyone in the room kind of just had this strategy of, well, you take on debt when you take on a venture capital investment. And so that's the best time to take on debt, because it's kind of taking you're giving away less of your equity at that point. And so that's a great time to take on debt, because over time the debt gets paid off and you remain with more equity, which is kind of the whole leverage buyout finance type mentality, right? So that's what the Silicon Valley Bank was. And then a lot of their collapse didn't happen because their investments were bad. A lot of their collapse happened because they invested in 10-year treasuries when interest rates were 2%. And then interest rates went up to 4%, and they were still stuck in these 10-year investments. And so that was really the biggest reason why they didn't do well. It wasn't because of the underlying investments. And so that's actually a really, really good news for the American economy, not great news for them. Any more questions?
I didn't know that, Leah. I did not know that little tidbit about them with the treasuries.
Yes, yeah, and
so interesting.
And that was First Republic that just happened as well. They were, you know, they just got caught up in kind of being lazy about their underlying investments and what they were doing with the money that was deposited into those banks.
Yeah, so interesting. I met the guy who was the online banking manager who had to turn off the online banking during, you know, that one day when it all happened, and he was devastated. But anyway, Leah, can you talk to us a little bit about how do you suggest founders create if they are interested in really growing big, right? And having a steady growth. So we're not talking about these tech companies that come in and that's not what we're talking about. We're talking about more of a sustainable type of business that's growing. What are some suggestions that you have for these women who, you know, they don't have a huge team, right? They aren't coming in with millions and millions of dollars to back their company in the very beginning. Mm-hmm. What are some suggestions that you have for them for helping them build a business that is ready to grow and possibly take on private equity?
Yeah, absolutely. And truth be told, you know, some of the companies in our portfolio, one of them being a fence company, he didn't start out with any, you know, investment. He started 30 years ago doing retail fence sales, and he's a sales guy. He pounded the pavement. He made the sales. They installed fences, and now he comes, you know, he sold his business into private equity, has had a wonderful return there. He helped us start a wholesale division. So we sold off the retail. He had a great exit. And then he's still, you know, a part owner in this wholesale division that's still doing really well. And so, you know, without, you know, that kind of gumption to get going at the very start, we wouldn't have had, you know, great success with him and building it out even more. So can
I stop you for a second there? So with that company, with this fencing company, before you bought him out, what level was he at and where did you take him to?
Absolutely. So he probably was at about 20 million in revenue when we bought in. We exited just a year and a half ago, probably now, for about double that. So 40 million. In addition, the wholesale division is just kind of like, you don't have a lot of basis in that. You don't have a lot of underlying investment in that, because we basically started it. We saw an opportunity right during the recession, and that business is probably going to get him another, you know, us another $20 million plus in enterprise value. So, you know, it's a 5 times return, you know, for us, and, you know, it's a great exit for him as well. So he gets that, what we call the second bite of the apple. So he held on to his equity, you know, some of that equity stake, and the equities, you know, that he rolled into the company is oftentimes for founders worth more that second time around when they sell with the private equity firm than that initial sale.
Okay, that's a really good benefit for us to be aware of when we're thinking of what's out there. And so I want you to answer the question I asked a second ago about what we should be thinking about, but also I want everyone who's listening to this to be thinking bigger, to really stretch our mind as to what's possible. Because as women, I see this all the time, and I've been guilty of it too, is that we hear about how you can't get funding, right? That people aren't giving funding to women-owned businesses, which is true. For the most part, maybe not angel funding, but in general, it's more challenging. And often, as Leah and I were talking before we started recording, is that women start playing smaller than what's possible. That's why we bring on these amazing speakers such as Leah to help us think bigger. So just kind of keep that in mind, that's how I want us to be thinking. Whatever we decide to build, I just want us to have that in mind, that we can do what we want to do with the right knowledge.
So let me go into what an investor is really looking for when they're looking to invest in a business. And this can be, you know, as far as an IPO, when you're doing a roadshow with an investment banker, you know, and you're just, you know, it doesn't matter if it's private equity or if a strategic is going to buy you out, like your competitor is going to buy you out, or if you do it initial public offering on the stock exchange. It's really about that enhanced enterprise value. And so there's kind of 8 different components. And I'm sure you guys know this, and it's just kind of what we're looking at when we're, you know, in that investor, you know, review process. So we're looking at a brand that's differentiated in the marketplace. We're looking at reduced enterprise risk. So what that means is we don't want to see a company that has only one customer being 75% of the revenue coming in. You don't want to rely on that, right? And the beauty of you know, women and women business owners is a lot of the time they're more risk averse, and so they're seeing these things. But you know, the bad part of it is that they let them, you know, they stop themselves too early on in the process. So anyway, going back to the risk part of that, customer concentration. Supply chain risks. And we saw a lot of that happen in the pandemic where products, you know, weren't available. And so you want to diversify your supply chain if you do have a product type company. And then your succession plan. What are you thinking of in terms of exit? And that is something that I've seen a lot in my career, business owners just not being honest with themselves, just not considering all the different potentials for an exit strategy. You know, is it, I'm going to pass it on to my COO? Am I going to pass on my company and have the management team as a whole buy me out? Am I going to pass it on to my daughter? Am I going to, you know, it's just that clear succession plan from the beginning. And really, you've got to have that vision. And what I love to do is educate people as far as the many options there are for, you know, exit strategies and kind of that, and that will help you, you know, get a clear succession plan. Obviously there's revenue. Is there recurring revenue? Is there a good mix of that customer diversity? You know, is it a construction product being sold into the housing market for retail housing that is completely cyclical, and, you know, versus a building products company that sells into government and retail and, you know, and multi-use, you know, real estate. So there's a lot of considerations as far as where, you know, where does this play in the market in good times and in bad? And you want to see like those questions answered of how is your business recession proof in a lot of ways. And you can build that in as you're growing your company. And then obviously gross margin and EBITDA, right? That's what we play on. We're looking at really strong EBITDA numbers and a good percentage of that money going into the ownership's pocket at the end of the day. And then, your innovation pipeline. If you're producing products, what are you doing next? What new products do you have in mind for the future? So we're looking at, you know, the vision, and is that vision in one person's mind? Is that in the whole team's mind? You know, what is the culture like there? Is it a culture of innovation, or is it just kind of coming from the founder? And once that founder goes away, no more innovation, right? Another piece of that is what you will hear of a lot in investing is the word moat. Have you built a moat around your product? Is it either too hard to replicate by another company, or is it too expensive to invest in, you know, the machinery for this product if it's a manufacturing company? So it's just kind of that barriers to entry. You know, how hard have you worked to create a differentiated company? And then also the talent. Do you have a secure plan for your management team? Do they have ownership? Do they want ownership in the company? You know, there's exits as far as like talking about IPOs or private equity or venture capital. There's also ESOPs, which is called an employee stock ownership plan. So you can give ownership to your employees as kind of the retirement benefit, in addition to a 401k. And then there's partnerships. So one thing that KKR, which is a really big private equity firm, is doing, they're doing kind of a joint ESOP and private equity investment. So the employees get to benefit from the resources of a private equity firm coming in and taking a stake in that company, as well as each individual employee gets ownership. And so it's like this wonderful combination. So the sky is the limit. And the fact that, you know, you can really have the vision, keep that vision in mind of, what am I going to do with this company? You're not just starting a company to work in that company and have a W-2 income, right? You're generating returns, and hopefully it's going to mean that it's a very successful exit for you on, you know, when you decide to exit the company, and whether you're selling it to a private equity firm or, you know, an initial public offering, there's tons of possibilities as far as, you know, getting that enterprise value out into the hands of people who really want to invest in it. And like you were saying, Midori, you know, it is hard for women-owned businesses to get funding, but I want to give you hope, because of the ESG guidelines that are coming down from the Securities Exchange Commission, because investors want that. At the end of the day, there's more and more and more capital being set aside for women-owned business, minority-owned business. And so,
Leah, can you tell us what the ESG, because you talk this jargon all the time and you're around these people who speak these acronyms, but can you tell us, because I don't know, what is ESG?
Oh my goodness. Yeah. So ESG is certainly something very important coming down from a lot of investors, a lot of like huge funds. Think of like Prudential Insurance or huge insurance companies that have to invest their money and make a return in order to keep, you know, the returns coming for their stakeholders. So ESG is environmental, social, and governance. So it's looking at those intangibles of a company and trying to quantify them. Like, for instance, how many women do you have on your board? How many, you know, what are you doing as far as reducing your carbon footprint? You know, all of those components are built into this ESG, environmental, social, and governance. And so it's about, you know, kind of quantifying the metrics to make a better, you know, better company besides just return, you know, or net income at the end of the day.
Okay. So that is now something that private equity firms are looking at.
Everybody. Yeah. So the Securities Exchange Commission, they're, you know, protecting investors, and that's their role, right? They, you know, are looking at different investment funds and making sure that the retail investor, people who are putting money into their 401k, are protected. They're actually coming out with a set of rules that will be imposed on public companies, which will then get imposed on the private companies that work for them, which then will get imposed on the suppliers that work for those companies. So it'll be a domino effect of metrics that you're going to have to report into, your customers if you are selling to a business, of what's your environmental footprint? How many women are in your executive team? What's your ownership structure like? It's really kind of a new level. And obviously nothing's set in stone yet. There's been a lot of back and forth. Obviously it's very politically motivated as well, but we know that it's coming. And so the investment community is very tuned into that. And I would say 15% of all the conferences I go to, which is a lot of conferences, everybody has a topic on ESG and what companies are doing about it.
Fascinating. Okay. Thank you.
Yeah. I'll stop there. I know I'm going fast and I've covered a lot. How are you guys doing?
Any questions from anyone? Is this helping spark ideas in your mind of areas for you to concentrate on, that maybe any ahas that it is for me? There's things that are coming up for me where I'm like, oh, I should be concentrating on this part of my business, which I didn't think about before. So anyone have any feedback here or any questions or comments? Moat. Jill says moat. Are you wondering about that, Jill? You're just kind of.
No, I think it's just something, in terms of even like with the angel investing, to think about like, how do you really solidify against your competitors? In the area that I'm in, it's there's a lot of people who kind of sort of are doing the same thing, but kind of not exactly. And it's kind of figuring out what is your secret sauce that you bring to the table, right? But it also has to be scalable. So that's kind of just what's churning in my head right now.
Exactly. And there's so many iterations of that, right? Because you start out, in a founder owned company with one idea, right? And you iterate from there, you pivot and you're agile and you find other opportunities in other markets to serve. So I'm not saying that, your differentiating factors have to be set in place as soon as you start a business. But that's what I'm looking at 5 years down the road when you want to sell your business to me, right? Is that how have you differentiated from your competition and how have you made yourself more valuable? For instance, some private equity firms are going to come in. This was a trend a couple of years ago where private equity decided that they were going to roll up, which means buy all of the dental offices. And so they would have a monopoly on dentists, right? And so they're going to buy all these dentist offices and then create this mega, company that has a ton of different dental offices. And so they did a roll up in that industry. So you see that a lot where private equity wants to have a hold in a certain industry that they haven't touched yet. What's a good example of this? Oh, grocery stores. You can probably on your hand think of 2 or 3 grocery store chains that you know of. How many small, tiny market grocery stores are you aware of in your area? Not a farmer's market, but like a small grocery chain with maybe 2 or 3 locations, right? There's not many. There's Albertsons, there's Kroger, there's, Whole Foods, there's Trader Joe's, because there's been so much roll up in that space. They've been acquiring smaller chains along the way. And so, that's just an exit, that some of these companies have had, is that there's just been that roll up. And so there's kind of a monopoly type situation. So if you're selling into the grocery chain, that you have to produce a ton of product in order to satisfy even just one grocery retailer. So that's an example of, what companies are trying to do. So it's not always about that differentiation, but it's about, how have you created value through that differentiation? For instance, you guys all know the difference between walking into a Trader Joe's and walking into a Walmart. There's a huge differentiating factor. It has a certain feel. It has a certain, the products all have a certain look about them. Whereas if you walk into Walmart, you're going to get a totally different experience. And so it's really about kind of thinking about, okay, how am I going to position my business so that the customer is going to have a certain experience when they're encountering me?
So let's go into that a little bit, because a lot of the women who own businesses and Fuel the Fire, it's built around their own personal brand.
Yes.
Right. So, however, but there are companies that sell, right? So it can be built around one person, but then the company sells and that brand carries on, still revolving around this person who may have a small share, but they're not the sole owner anymore. Can you
Right.
hit on that a little bit?
Well, yeah, I mean, I think there's a zillion ways to do that. Well, whether it's a, one personality kind of being the guiding force, but then also in order to scale that, how do you scale it beyond yourself? What are the differentiating factors that you're bringing to the table that somebody else couldn't come in? You hire a chief operating officer, for instance, you want them to have that same approach as you do. And that's when you're starting to really establish a culture. Hey, we don't reach out to our customers in a really informal fashion. We are formal, or we're not formal, whatever it is that you're doing, you're investing the time in. And that's a hard part about employees, right? Is they do take a lot of time up front. And what you see with a lot of larger companies that do well in their customer service or whatever it is, they're taking the time to really invest in their partners, in their staff, so that a customer will have the same experience no matter who they connect with at that company. So, yeah, go ahead.
You know who I felt like did a really good job of this a while ago, and I think all of us know this company, but Zappos. Remember when Zappos rolled out? Ladies, you all remember that? And all of it, this is before Amazon was doing 2-day shipping, but Zappos did. I remember who I knew the UPS guy because I was always getting orders, but I would order a pair of shoes and it'd be there then like the next day or the day after. And that was shocking back then. But I remember when I had to return them, their service was so excellent. It was never a problem. And it was all part of their culture that Tony Hsieh had created. And so, but it was revolving around him. He was the one who did it, even though, it was a Zappos name. It wasn't the Tony Hsieh name. We all knew Tony Hsieh was behind all of it. Right. So I think that's what you're talking about is what's the culture that you're creating? That's the culture that he created. It was all about very customer centric.
And that's the challenge, right? And I'm sure for you guys, the push and pull of entrepreneurship is focusing in, but then also not focusing on just one thing, but taking care of, all of those different components. And that's where, over time you grow to a point where you can hire someone on and help to duplicate yourself in small ways until you've worked with that person enough where it's like, okay, now we take on a third person and we bring them into the fold as far as, how we approach things and what our culture is. And by that point, then, you're really off to the races and you're, generating revenue and it makes sense to, start to scale.
So the companies that you invest in, I think, did you say they are all at least 3 to 5 million?
So 10 million in revenue is generally the minimum that private equity will invest in. And there's different cases, right? If I wanted to get if I saw, just trying to find an example. There's one actually that I was just looking at. It's a skincare line and it's their gross margin is fantastic. Their net profit is fantastic also, but it's 7 million in revenue. Would I not look at that? No way. I'm going to look at that because there might be edge there, and there's, and when I say edge, that means, an edge over the competition, as far as nobody else is looking at this. So I'm going to, and so that's really what it's more about is if I find a brand or a company that is doing 7 of the 8 things I talked about really well, I'm still going to look, even if it's not $10 million in revenue, because they've really focused in on building that value, that enterprise value.
So if someone decides a company's one of my founders, they're building up really quickly and they're interested in partnering with a private equity firm to help fund their company and help it grow. And that's kind of their exit plan. How do they go about that? Do they create a whole pitch deck for you? What are the steps to do that?
Yeah, that's a really great question. And there's a lot of ways to do it, right? There's not just one. One thing that one of the ways that we find deals and most generally is an investment bank. So it's not a bank necessarily, it's an investment bank. And so investment banks are put in place. Think of the big ones like JP Morgan, Goldman Sachs, Jefferies, Piper Sandler. Those are investment banks that'll help you go public, right? But then there's also a lot of very small investment banks. I work with one that's 3 guys out of, they're out of the Netherlands, and they, find capital for companies. So they'll find larger loans for companies. They will shop it around to all the different banks, lenders. And then there's, so there's a variety of different investment banks. And so an investment bank is an important aspect of the private equity world, because they're going to be reaching out to me when they have a client who wants to sell their company in full, or wants a minority investor, or needs $20 million for this one project in order to really scale their business up. Then, they'll go through an investment bank to find that partner. So in that respect, the investment bank is helping you with your pitch deck. And so you're not doing it alone, right? And that's why one of the things I really preach is kind of investing in your advisors, right? An investment bank is going to be that partner who's going to help you sell into private equity, or help you, do an IPO. You don't have to do it yourself, and that should be a sigh of relief, right? It's like, yeah, those advisors, yeah, there's a success fee if you get a huge investment, but guess what? You're not really gonna care, because it's going to be like 50, like 5%, or not even 5%, 2% of the total transaction, and you're going to be left with millions. So that's really what it is that there's partners that are going to help you with this. So investment banks are probably the main one, but then there's, financial advisors. If you go to your financial advisor and you say, look, I want to get a plan in place, I want to sell my company in 10 years. That financial advisor, we network with financial advisors because it's a great way to kind of bypass that investment banker and get connected with business owners who are willing to look at private equity as a way to sell their company. So there's a lot of different avenues that we look. We're not just looking in the investment bank, which is kind of the gold standard of how you do that. And then there's, you're putting together a board, for instance, for your company. You have advisory board members, or, a part equity owner who's going to sit on your board. They may know people. And so that's kind of how private equity works in a way, and still does. And why it kind of has stayed at old boys club is because it really is it's just people. It's just people who have relationships with each other saying, hey, do you want to invest in this company with me? Or, hey, this guy, has a company that we can invest in. So that's why it's kind of stayed so small over time, is because it's just, you get comfortable with the same people over and over again sometimes.
Okay, so Leah, I have to, this is like, I love this so much. Can you talk about this a little bit more? I know that you're in the private equity world. However, you clearly are quite connected in the rest of the financial world.
Mm-hmm.
So as very small business owners, female-owned businesses, can you give us some advice on how do we go? Like, yes, I have a financial advisor and she knows me well. However, an investment banker, how do you go about that? How do you go about, when do you go and talk to an investment banker? How do you go and talk to them with an end of mind that you want to build this big business, but you've never done it before? So how do you
really great? That's a really great question. And I think, once you do have that plan in place and you're working that plan and you are starting to see revenues, if you're wanting to sell your company, you need at least 2 years in order to start these, minimum in order to start these relationships with investment banks. And that's where, that's where private equity, really plays. We're looking at the market as a whole. I'm looking at economics. I'm looking at farming and agriculture. I'm looking at all of these different inputs in order to make an investment decision, because at the end of the day, I'm an investor, right? And so everything has this beautiful connection to each other. And so you can never go too far in order to find, different investments. And so for instance, you know, there's in the same way that a business owners association may just kind of stick with other business owners, investment bankers kind of like stick with other investment bankers. And so you find pools, there's associations, there's, you know, and it's, you know, there's your bank, right, that may have a connection into, and hopefully does have a connection into, an investment bank. So that is a good place to start. Your banker, your financial advisor, a lot of those people have expertise that you would never even think to tap into. A lawyer, an M&A attorney, like there's mergers and acquisitions attorneys that will help you, you know, structure your your exit so that you're getting the most bang for your buck, and you know you want that already. Accountants, so all of those kind of peripheral advisors are really going to be good introductions for you into that space.
Okay, this is so fascinating to me. So ladies, as you're thinking about this, think of, you know, the groups that you're in or the groups that you want to be in, because often you can just go, look how easy it is to talk with Leah, right? And so playing where they're playing and just getting to know them and building a relationship as a friend, right? And then expanding it from there and just having some doors open, but I think that's a way for us to play bigger when we're starting this.
They want to meet you. They are looking for you. They want to talk to you. They want to be in a relationship with you because they benefit just as much as you will, you know? And so really at the end of the day, it's a people business, and we're happy to build those relationships because it does take a number of years. We have one company that has been coming back to us 4 years in a row now to sell their business. And it's been direct. It hasn't been through an investment bank. So they haven't run a whole like auction type process. But they're just not ready yet. And that's okay. We'll be with them, you know, in the next few years, if that's, you know, something that's, you know, still on the table for them. So it's okay to not be 100% sure of what it's going to look like, or, you know, what exactly the exit is that you want to take, or what exactly it is that the investment that you want to do. That's okay. You can start that relationship very early on, and they'll be excited about it, and they'll be rooting you on. And a lot of the times, if they're a good banker or a good lawyer or a good accountant, they'll have a zillion connections for you to meet in order to build your board, hire employees, you know, whatever it is within that industry that you're trying to get into.
Okay, so can we talk about building your board a little bit? Because when I think of that, I think of, you know, big companies or people who've left big corporations, right, to go off on their own, but they already have all these connections that are, you know, very high level. So how does one go about building a board and finding the right people who are interested if you can't pay your board members?
Sure. Yeah. Oh my gosh. So there are so many people who, you know, whether it's like I keep repeating, an investment banker and a lawyer, an accountant who's rooting for you, who's on your team, and you just say to them, I'm really looking for some advisory board members. An advisory board position usually isn't paid. If it is, they get reimbursed for, you know, travel or, you know, whatever it is for a certain board, but that's about it. But there are so many people who want to pour into companies, who are nearing retirement age, have worked at huge companies, have scaled, have grown. I'd be happy to connect you with people who, you know, are in your industry looking for, you know, looking for that board experience, or to just help another company out. So I think that's, you know, you say high level, and I don't want people to get, I don't want people to be intimidated, because a board member is just another person, and they have something to offer, and they have something to contribute, and people love hearing the sound of their own voice, and they love giving advice, right? But that advice might be really valuable to your company, right? And so it's a mutual thing where it's rewarding for them, but then you're able to build off of that expertise and their connections. And, you know, think of private equity as the the connection on steroids as far as, you know, the resources we bring to the table. I hope I've shown that it's the connections, it's the expertise in the investment community and the finance community, knowing what the economy is going to be doing, or, you know, as much as we can anyway, so that we can be a really good partner to a business owner.
All right. So I know we just had Erin pop in here. Erin, are you still here? I'm looking at a different, she is. I don't know if she can talk right now. She's in her car a lot or moving around.
Hi.
Hi, Erin.
Hello.
So Erin owns Telegenics, and they are incredibly fast growth. And Erin, you guys are what, under 3 years old, correct?
We are. Yep. We are. Or 2021 was when we incorporated.
Okay. So do you have any questions? I know you just hopped in a few minutes ago, but do you have any questions for Leah or any comments?
The only, kind of immediate insight I think I'm looking for is, as I am building a board or looking at potential investors, though I think I do have a little skew towards individual investors versus institutional, I guess. What are the types of questions, skills, pieces of network that I should be looking for to make that relationship the most productive for me? The context is, it's a digital health platform focused on regenerative care. So really in that space.
Yeah. So I think there's a lot of ways you could go with that. And you know, to Stacy's question as well, you know, subscription online, absolutely. I have several private equity firms that I'm aware of that are investing in tech only companies or tech enabled only companies where there's subscription revenue. It's an online business. So it's every industry really. In the med tech startup space, oh my goodness, the amount of, I mean, Minnesota especially is a really big incubator. We have the Mayo Clinic here. So as far as like health and wellness type companies, there's a lot, as well as tech companies, surprisingly too. You know, for instance, I would get you hooked up with Morgan Evans, who is a kind of angel investor, venture capitalist. But she would be somebody who's, you know, she started 6 different health tech, med tech startups. And she has an incubator. She has a service company to support those companies as far as their HR, accounting, IT functions. So there's a lot in the investor community, especially here, that are, you know, kind of focused in on those medical, you know, or telehealth type medicine companies. The other piece to that is, you know, the associations, right? And a lot of the time with the medical community is that it's a doctor who's started a product, you know, and they're working with different doctors to invest, and they kind of club the deal together. And so that's a lot of the time what I see when you're looking at kind of individual investments is those other health professionals. But then, you know, institutional wise, there's a lot of associations where you can find a wealth of resources for that. There's one called, oh my goodness, I'm going to get this wrong, Groove Capital, where they just have like an angel fest kind of every year. And so they're invested, you know, they're inviting business owners to come in, and it's a bunch of individual angel investors plus, you know, medical professionals in the community looking for new innovations, you know, et cetera, et cetera. So there's just a wealth of that type of activity out there.
Thank you. Yeah, thank you, Leah. All right, we are just about at time. Are there any other comments or questions from anyone since we have Leah here with us? Or Leah, do you have any parting words for us that we should be aware of? Any ideas or suggestions as we build?
Oh my goodness. Well, never stop learning, right? Never stop making those connections, and never discount yourself, because there are investors out there looking for your company. And so, know how valuable it is that you're an entrepreneur in the space that you're in, because you're driving the American economy. You're contributing to how our country is running, and that should be a really fulfilling thing for you. Bring in great advisors for your company, and make that investment. And, as far as learning about private equity, follow me on my podcast. I'm launching in a little bit if you want to learn more, or, reach out to me. Feel free to, as far as, finding resources or connections within your industry. I'd be happy to help, recommend board members or whatever that looks like for you.
They're asking, what is your podcast? Where
Yeah,
where can we find information on you, Leah?
It hasn't launched yet. It's launching probably at the end of this month. It's a series. It's called People of Private Equity, but it'll be on Apple, Spotify, all the big podcast channels.
Okay.
And it'll be, and it's targeted for business owners. It's talking about what M&A looks like, mergers and acquisitions, that is, as far as, who's involved, what it's like to work with private equity. I have a couple CEOs who are going to be talking to me about that. So it should be a fun podcast.
Absolutely. So we can find you on LinkedIn.
Yes,
correct? I know
absolutely.
you're there. So that's probably a good place to connect with Leah. Anywhere else that we should be following you so we can stay up on all these?
No, I
things
think
you have going on?
that's the medium I'm on most of the time. So you'll see me on there.
Okay, perfect. One little tip, I don't know if we talked about this before, Leah, but I don't remember you talking about your podcast, is Podopolo. Have you heard of Podopolo?
No.
It's a platform that is run by, it's a woman-owned platform. She comes from the tech world. She's in Silicon Valley forever, and she's huge on AI and data. And so it's free to put your podcast on that platform, but she has millions of dollars in data research that will help push out your show to the right audience.
Cool. Wow. Okay.
Yeah, and then do some cross promotion for you too. So just,
well, thank you.
Yeah,
thank you.
Just something to think about. Thank you so much for all of this. I hope everyone is leaving. I know I am leaving with stretching our mind a bit of what's possible for us business owners and where we can go. Jill is, I think, yeah, everyone has really enjoyed this, but thank you so much. And I hope to stay in touch with you, and I will be picking your brain more, just so you know.
Please do. Please
Yes.
do. I love to be a resource if I can. Thank you so much for the opportunity to speak with you today. Bye, guys.
Thanks for being here.